And the Federal Reserve cutting interest rates by a quarter percentage point. It was interesting, called risk management by Jay Powell. Kind of an interesting term. We'll ask Roger Ferguson about what he thinks that means. It was the first cut since late last year. The vote was 11-1. One new Fed governor, Stephen Myron, voting for a 50 basis point reduction. The Fed signaling 2 more cuts could be on the horizon before the end of the year. But there was a wide disparity among expectations.
Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you've got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views.
Joining us now, former Fed Vice Chairman Roger Ferguson. He is now Vice Chairman of the Business Council, a Conference Board trustee, CNBC contributor, and an early riser today. Roger, you feeling all right? How are you? Have some coffee? You good? Mainlining it? Or?
I'm ready, Joe. Joe, I'm so happy to be on with you. I'm sorry that the others aren't there, but I'm more than happy to do this with you.
Likewise. You know what? I don't detect a hint of sarcasm there, and I don't think anyone should. Would you have voted?
There isn't a hint of sarcasm there.
No, there isn't. Would it have, if you were still there, would it have been 12-1, Roger, yesterday?
Probably. I think they did the right thing. Most importantly, I thought the press conference laid it out very clearly. The clip that you played, I think, really captured the essence of the policy dilemma. As we've been saying many times, you and I, inflation is still high and likely to go higher, maybe gradually. The labor market is showing weaknesses, but there's some questions what's driving it. So I think the risk management cut that Chair Powell talked about was actually the right thing to do.
What does that mean? It means that we're not sure? I think it means we're not sure. We got two concerns, maybe labor market weakening and inflation. Is it 3%? Would you say that's 50% above the target? And we haven't hit the target in how long? Three or 4 years, I think. But we're 50% above the target.
Quite a while. Yeah, no, I agree. I've been saying all along here that this is two-sided risk. I think the concept of a risk management cut is, the balance of risk, as he described, is moved towards weakness in the labor market. They don't want to see that to accelerate. And so to manage that downside risk, they are taking this cut and signaling the possibility, though not the certainty, of 2 more. I think it was very clear in answer to, I think, Steve Leisman's question that this is sort of meeting to meeting. And so I think he played a tough situation straight down the middle as he possibly could have, being very clear about the challenges that the Fed confronts right now.
Well, I could tell where you still have been somewhat concerned. It seems more concerned about inflation than a slowdown, and maybe rightly so, given the stock market. I mean, I don't see anything even looks close to a slowdown, and maybe the market goes up on anticipation of an easing, but it also goes up on corporations doing well in terms of earnings per share. So, you've got some cross currents, definitely. But when I asked you, you said, would it be 12-1? The best you could muster up was a probably. You didn't even say, people use the word absolutely. You didn't even say absolutely. No. You said said probably. You didn't say, oh yeah, Joe, definitely. You said, well, probably. I think it might have been 11-1 if you were there. Stand pat.
To be very clear, there was one of the dot points, probably someone who didn't vote, that thought they should have stood firm last time, or this most recent meeting. This is not a foregone conclusion. Yeah, someone did. They didn't vote. It wasn't a voter, so it's probably one of the presidents who wasn't voting, who, according to the dot plots, would not have moved at this last meeting. And I think Chair Powell said it very clearly. Given the uncertainties they confront, one shouldn't be surprised to see such a dispersion across the dots. But to be very clear, I would have voted for the 25, but I would have also been probably in the more cautious camp about the future outlook, because that's, I think, where the question really lays here. And there was a lot of dispersion in the future outlook as well. So, I thought it was well played and well explained by Chair Powell during the press conference. And one other point that you made.
Yeah, go ahead. Sorry.
On the strength of the economy, the most recent data that we've seen for retail sales, I think, surprised people on the upside. So it goes to your point. There's some steam left in this economy. It may be slowing, but it is not falling off the cliff just yet. So I think the Fed's doing it the right way.
The cover of the Journal, there's something for everyone. I was gratified by some of the stories, but this one's very disturbing, and it highlighting the divergent American economy that we've seen of the haves and have-nots getting even worse. So I guess what I was thinking, will this help with mortgage rates? There's coming down maybe a little, but people think nothing till under 6 really helps. And then the stock market, I know people have 401ks, but it does seem to, the well-heeled do seem to do a little bit better. So a strong stock market doesn't mean everyone's participating in the economy. And I don't know what we're supposed to do about that.
Well, look, I think you're right there. There's nothing much the Fed can do about it, for sure. On the housing market, it's a very complicated story of supply and demand. We're probably 2 to 3 million houses short of what we need in this country. So the story there is not purely mortgages. And you're right. This reduction of 25 basis points, as Chair Powell said, is moving in the right direction. It's not going to dramatically change the housing outlook. On your bigger picture question, I agree. This is a much more complicated economy than the headlines might suggest. I've seen data that suggests that much of the consumption that we're seeing right now has very little to do with call it the bottom 80%, people making less than $175,000 are keeping up but not getting ahead, barely keeping up. So much of the consumption is, as you point out, from the well-heeled Americans out there who are enjoying housing equity prices in the market, and good solid incomes and returns on their investments.
I mean, Roger, are you convinced that long rates are eventually coming down? I mean, if we take our eye off the ball for inflation, the opposite could happen.
No, I agree. That one of the things I've said a few times ago when I was on with you is, the president has to be a little careful here. Trying to drive down the short end of the yield curve is not necessarily going to result in anything but uncertainty out at the long end, with inflation premiums starting to rise out at the long end. And also, anything that undercuts the independence of the Fed, I think, is not going to help the long end as well. So you're absolutely right to say this, that 25, maybe 50, maybe even more on the short end is not guaranteed to reduce the borrowing costs for the U.S. at the long end or for others who are out at the 30-year end of the curve.